There are over 100 technical indicators built into your charting platform. And here is the uncomfortable truth. Most of them are telling you the same thing in slightly different ways. Stacking 5 of them on your chart does not make you more accurate. It makes you slower. So in this video, we are cutting it down to the 5 indicators that actually matter for swing trading in 2026, why they work, how to set them up, and how to combine them into one system that gives you a real edge. Let's get into it. Number 1. Exponential moving averages, specifically the 8 and the 21 EMA on the daily chart. Forget the 5200 golden cross for swing trading. By the time those cross, the move you wanted is half over. The 821 combo is fast enough to catch swings early, but slow enough to filter the chop. Here is how to use it. First, the trend filter. Price above both moving averages and the 8 above the 21. You only look for longs. Reversed, you only look for shorts or you stay out. Second, the entry zone. In a healthy uptrend, pullbacks to the 21 EMA are your buy zone. You are not chasing the breakout. You are buying the retest. Third, the exit signal. A daily close below the 21 EMA is your warning shot. 2 consecutive closes below it, and the swing is over. And the reason this works is not magic. Enough institutional and algorithmic money watches these levels that they become self-fulfilling support and resistance. Now let's see this on real charts. This is NVIDIA on the daily. It is trending hard, riding above the 8 and 21 EMA. Then it pulls back, straight into the 21 EMA, holds the line, and launches the next leg higher. Same playbook on Tesla. A clean retest of the 21 EMA. Buyers step right back in, and the uptrend continues. These setups are not cherry-picked. Strong stocks do this again and again. Number 2, the relative strength index, but not the way you were taught. You probably learned, buy below 30, sell above 70. In a trending market that gets you shorting strength and run over, strong stocks stay overbought for weeks. Use RSI 2 better ways. First, regime. In a real uptrend, RSI lives between 40 and 80. It rarely touches 30, so when a stock pulls back and RSI holds the 40 to 50 zone, that is not weakness. That is your entry. Second, divergence. When price makes a new high, but RSI makes a lower high, momentum is fading underneath. That is your signal to tighten stops and stop adding. Settings, standard 14 period. Do not over-optimize it. RC on Palantir, real daily data. Price prints a lower low, but SI prints a higher low. That's bullish divergence. The selling is running out of steam. Buyers stepped in and took it into the next leg. Number 3 is a pair. Raw volume and anchored VWAP price tells you what happened. Volume tells you whether to believe it. A breakout on 3 times average volume is institution's positioning. A breakout on below average volume is bait. Simple rule, no volume, no trade. Now, anchored VWAP takes this further. Instead of a rolling line, you anchor it to a meaningful event, an earnings gap, a 52-week high, a major news day. That line is the average price of everyone who bought since that event. When price pulls back to the anchored VWAP and holds, that is institutions defending their cost basis. One of the highest probability entries that exists. ORCL. Anchor VWAP to the breakout, then watch price pull all the way back to the line. It holds big money defending their cost basis, and then it rips higher. Number 4, average true range. This one does not generate signals. It keeps you alive. A TR measures how much a stock actually moves per day. A $50 stock with a $3 range is a different animal than one with a 50-cent range. 2 uses. Stops. Place your stop 1.5 to 2 times a TR below your entry. Tighter than that, and normal daily noise stops you out of good trades. Position sizing. Risk a fixed amount, say 1% of your account, and divide by your ATR stop distance to get your share count. Volatile stock. Smaller position. Quiet stock, bigger position. Same dollar risk every time. That is how professionals normalize risk. Shopify. Entry here with the stop 1.8 times a TR below. A tight stop gets wicked out on the noise. This one breathes, survives the shakeout, and rides the move. Number 5, MACD, but as a confirmation tool, never a standalone signal. MACD lags. That's by design. It's built from moving averages, so using it as your entry trigger means you're always late. But that lag is exactly what makes it a great filter. It ignores one-day head fakes. What I watch is the histogram, not the crossover. When the histogram is shrinking towards zero during a pullback and then flips direction at the same time, price is bouncing off the 21 AMA with volume that's confluence. That's the moment three independent things agree. And AMD. The histogram flips green as the MACD line crosses up from near zero. Confirmation, with price reclaiming the AMS. The move follows. So here is the system. No single indicator is the edge. The agreement between them is, before any swing entry, run this checklist. 1. Trend. Price above the 8 and 21 EMA. 2. Momentum. R. SI holding above 40. No bearish divergence. 3. Institutional interest. Volume confirms. Price respecting anchored VWAP. 4. Risk defined. Stop at 1.5 to 2 times a TR. Position size to 1%. 5. Trigger. MACD histogram turning up as price reclaims the EMA 4 out of 5 minimum. Or you pass. There is always another setup. That is the toolkit. 5 indicators, 1 checklist, 0 clutter. If this helped, hit subscribe. I break down setups and the stocks I am watching every week. Drop a comment with the indicator you cannot trade without. And remember, nothing here is financial advice. Always do your own research. I will see you in the next one.